episode 46. Today, we're going to interview KC Chong, invest like a stock market guru, the complete value investing guide that works. KC originally trained as a civil engineer, but started investing in stocks since the 1980s. As an investment coach, KC has written 400 investment articles, sharing his knowledge, experience, philosophy, and methodologies in investing. KC has a diploma in personal financial planning, also a master in finance, and currently lives in New Zealand. So together, we're going to find out, is value investing dead? Or how do we perform stock analysis? How do you select good stocks at fair prices? What are KOI's 5 yardsticks of value investing? And so without further ado, let's welcome KC to the show. Hi KC, welcome to the show.
Hi KC.
Everybody.
Hi, welcome to the show. Good to have you here.
Thank you.
Yep. So for the benefit of all our audience, could you please briefly introduce yourself?
First of all, I want to thank Steve and Kat for inviting me to this wonderful podcast. As I just told them that it's a very useful platform for learning about personal finance, investing, that kind of things, you see. So very good. I also noticed there are a lot of activities in the platform. That's very good. Kat just introduced me. I was working as a civil engineer for many years in Malaysia and Singapore, starting 1980. As soon as I graduated from local University of Malaya, then I started working.
Okay.
Yeah, So after that I worked in the government in one government drainage and education department as engineer for 10 years. Then after that I worked in the private sector. So altogether I worked about 23 years in Malaysia as an engineer. So
wow.
Yeah, as I was introduced by Kat, I have experience in investing for 40 years. But for the first 25 years, I just simply do more of speculating and gambling. I know nothing about investing, actually. I do read something, but don't really know much. So it's more speculating.
How did you really start then? Did a friend or family member or someone talk to you about it, or you found or you read something right at the start?
You see, when after working for 22 years as an engineer in Malaysia, my friend asked me to migrate to New Zealand. It's a strange place, because I was born and bred in Malaysia. In New Zealand, I don't even know where's the capital. I thought Auckland is the capital. So, but he keep on asking me to go to migrate to New Zealand. Finally, I just went. So in sometime in 18 years ago, I went to New Zealand. That's more for most of us are for migrating to either New Zealand, Australia, or overseas. It's more for children's education. So it was a good move actually for children's education. They got very good education, and somehow it's for free.
Wow.
It's almost for free. Because I was thinking that if we were to send our children, I got 3 children. If I were to send them overseas, that would cost me a lot of money. So having them have the education here for free, that saved me a lot of money. So that is the motivation.
And that money is the money you can put into the stock market instead, is it?
Not like that time. Actually, when I migrate, I worked so many years, especially in Singapore. I do save quite a lot of money, because I did went to quite high up in the bank as a country manager, and then all expenses are paid for, car provided, everything. So I actually save a lot of money in Singapore. So with that money, I thought I can go to New Zealand. I would try to get a job, but even I couldn't get a job. I think with my saving, maybe I can still survive. So I went there. I tried to get a job as engineer. I put up letters, hundreds of letters, but none is successful. Only a couple of interviews, but
okay.
Hundreds of letters, but only two letters so for interview, but unsuccessful. Then I start working as a supervisor for a couple of years. Okay, I didn't like it, so I thought, hey, here I got an opportunity to study, and I like finance. Although I'm an engineer, I like finance and investing. So why do I study? So I went to university and I studied this financial planning, and after that I studied my master. Yeah, I was top this master of finance.
Wow.
But having this qualification, having a degree in finance investing doesn't mean that you're very good investing. In fact, it can be a shortcoming, because we are actually all brainwashed about efficient market hypothesis. You know about that? Efficient market
is that
is
disjoint
efficient.
then, between theory and then practical really
theory,
being out there in the markets.
So we are brainwashed. So we are brainwashed that market is efficient. There's no point in trying to profit from the market unless you take extra risk. So all the time, if efficient market, so didn't really benefit a lot from the study. But I do learn something very useful, but simple one, as accounting. Basic accounting, how to read financial statement, how to do valuation. Those are very important, but those are just small part of the curriculum. Then after that, I'm quite free, so I read a lot of books. Auckland, there are so many libraries. You can go to libraries and you get so many books all free. So you go and read books. So I started reading books like like Peter Lynch, One Up Wall Street. Pat Dorsey, and many of these a good investor, how they do investing. Actually, I learned all my value investing from all these people, from reading books rather than from my studies. Okay.
Right. So, books can be tutors as well, and I see a lot of parallels as well. I did my degree as well. After that, I did my masters, and it also had some portions in finance as well. So like how to value companies, etc. And I've read a number of the books that you mentioned as well. So definitely very helpful.
There are some very helpful. Then after reading the book, then I was still doing investing. Initially, when I first started investing, I know more speculating gambler. I lost money. But at the time, not a lot of money to lose. But later I got more money. I still investing, but I am basically quite a risk averse person, so I don't take a lot of risk. I don't. Later, when I got money, I still invest, but I don't lose a lot of money. Probably I make a little bit, or maybe lose a little bit, not much. But after I embark on this journey of value investing, after reading all these books, I start doing that way. I find that it really works. It really works. It's a very logical thing. Value investing. To buy good companies at cheap price. It's very very plausible way of doing investing. It should work, and of course it works. But of course, nothing works all the time. You cannot be working all the time. If that thing works all the time, the benefit will be arbitrage away. So sometimes it works, sometimes it doesn't work. That is important. Eventually it will work. So that's how
I'll agree with that. You don't need to win 100% of the time. Actually, you just need above average betting average to win.
So after I start this value investing, I just noticed that you have a question like, is value investing dead now? So to me, no, definitely no.
In a little bit, that's definitely a topic in today's market. But so I have a copy of the book right here as well. So we jump into the very first question itself. So what inspired you, to write this, complete value investing guide that works? I know it's not easy to write a book, so and it's really thick, it's really good value for money. So what inspired you to write this book?
Okay. I think some time ago when I started, I don't know how I discovered this blog, i3 Investor. I couldn't remember how I discovered it. So I went there, there are a lot of people talking about investing. In fact, a lot of arguments, a lot of quarrel there, But they are sure something to learn from. Then I started writing article, and that time when I write article, there are quite some people follow me, There are a lot of people asking me, hey, this stock can buy or not? This stock can buy or not? So I go through quantitatively looking at the metrics. This one is good. That one is that one no. So I actually established myself, because it so happened that maybe because of luck, those questions they asked me whether stock can buy or not. I said can buy. Oh, a lot of the stocks are actually gone up a lot, those stocks cannot buy, actually gone down, So probably due to luck. So I established myself there. So people know me. Then I start this course, online course. Also, somebody asked me, like, why don't you start course, teach course? Okay, I start. There are people who actually follow me, So I got some. I don't earn a lot of money, but it's my passion to do that. So I started course, and then I have quite a number of students, maybe close to 1,000 so far,
Wow.
Students. Then as I said, I wrote a lot of articles in i3. So actually, it become natural. I got a lot of articles in the. I wish I can compile to do a book, but still I'm lazy to do that. Then somehow I got one student who actually is an accountant of this person called Fung Shiling, Ko-ai, Leng Yan. So invite me for lunch. So after that, we become friends. Often go for lunch, at this one Utama.
And so talk about stocks, said, right?
Yeah, he talked about stocks, and I said, hey, KC, why don't you write a book? I said, no, keep on encourage me. That's how the encouragement from Ko-ai to start writing a book. Of course, the other guy is John Lim. John Lim attended my course before.
Oh, okay.
So I met up with him. He said, yeah, why don't you write a book? I think. I said, okay. And also, because he is so supportive, he sponsored me to write a book. I don't have to come up with a single cent,
For those who are wondering who John is a publisher. So he's the publisher of KC's book as well.
Yeah. That's why with the encouragement of Ko-ai and then John Lim, I started writing it. It took me a long time.
How long did it take you from the...
I think at least...
decided?
Yeah. I think at least 2 years from beginning until the end. Because, a lot of changes and the kind of things. So finally, I wrote the book. And I thought this book cannot sell. I don't mind subsidize in publishing it. For example, if I can publish, I can print 500 copies. In fact, I can try to sell to my past course participants, maybe useful to them because they know about what I am doing, what my principle, what my teaching. They probably know, because the book is quite hard. There's so many things inside the book, or hard stuff. Only maybe my online investment course participant would know. Outside, because in outside, the books to be able to sell, you must be simple, easy, right? Easy to read.
That's the trend, simple, easy to read.
Yeah. But to me, sometimes things are too simple. I don't think you can make money from too simple things. Everybody will be able to do it. So
no mode, is it?
No mode. Yeah. That's how I come up with the book. And actually, I was surprised also because of the help of John Lim. John Lim, he was very good. He go and actually do some what do you call that publicity for me. So he get the Age magazine to interview me. Well, that was good. That guy very good. He introduced me, and then he published. And then a lot of people knows me. And then also because of MCO, a lot of people are locked down. So they can do some reading, and they order the book through me. A lot of them order the book through me. The time I those order from me, I can give autograph. Some people are happy with that. But you can order from NPH or my publisher Ace Premium. So that's how I publish a book.
Interesting. So were there any surprises or key challenges faced while you were researching and writing this book?
As I say, actually I have written a lot of articles in a public forum, and also in my course. I have a lot of course material, so it's a matter of compilation and updating. That part not too difficult, except that I have to go through again and again. A lot of time spent on it. So basically, not that much of challenges. As I said, most of the materials are there. Yeah.
So I guess the hardest part is actually to pick and choose what you want to squeeze into that one book, right?
Yeah. I written 400 over articles. There are a lot of things, but a lot repetitive. The article a lot repetitive because value investing. There's just so much. They are not to say everything is new. It's very. It's not a very wide thing, it's quite a narrow kind of thing. Buying good company at good price, and what is good company, what is cheap price. Basically, that is it. How to look at the business, the mood of the business.
That's a good segue as well. So, maybe we can move in a little bit into that as well. Yeah.
Something more technical.
What is value investing? If you ask 10 people, they may have different definitions as well. How would you, KC, define what is value investing?
Actually, there are a lot of misconceptions about value investing. You'll be surprised. Some people think that value investing is buying cheap stock, penny stock. That is not surprising. But most people have the misconceptions about value investing. They think value investing is just buy cheap in terms of price to book and price to earning or high dividend yield. That's considered cheap. But actually, value investing, like you say, it means different thing to different people. I know a lot of growth investors investing in high growth technology stocks. They consider themselves value investing, because basically value investing is, you buy something at a price with the value much higher than that. That value can be present value, or it can be future value, right? Growth stock, the value comes from the future. Right?
Correct. Yeah.
Value stock, most of the value comes from present or the next couple of years. But growth stock is for way in the future. So basically, value investing actually is like, what is value? Value, we use intrinsic value. Intrinsic value is actually all the cash flow in the future discounted back to the present. What is the value? That is the value. So it can be growth stock, where the value in the future discount back to the present, or it can be a value stock with the present value. So
that's true as well. And thanks for clearing up that misconception. There are people who think that value investing is about stocks that are like 20, 30 years old. It excludes all the tech stocks and all that. But those are all definitely misconceptions.
Yeah. Some people think that value investing is just buy those blue chip lah. No, that's not value investing. Actually, that is really not value investing. Yeah.
Yep. There are also some who think that value investing is dead. So does it still work in today's growth-focused market?
All right, and feel free to share as well. I know KC, you have some slides, so if you want to go through that with us.
Before the slides, value investing dead. I just happened to Google today. There are scores of articles about value investing is dead. Is value investing dead? I mean, my short answer is no. No with the exclamation mark.
A few exclamation marks, right?
Yeah, with the exclamation mark, because I am a value investor. I call myself a value investor. For the past 15 years, when I start value investing until now, I'm doing quite reasonably well. Of course, during these few years, there is a little bit up and down. In 2008, there's something down, and then maybe 2014 a little bit down, and then 2018 also was down. The market was quite down. But if you look at the long term from 15 years ago now, my own experience, and also you can see my portfolio, which I published in i3. They are all value investing portfolio based on different value investing strategy. They are all doing well. In fact, they did very well in the first 5 years. Okay, very, very well. Because in 2018, but still over long term, still very good. So my own experience here is not. But a lot of people, this statement about value investing is dead. Is, I think, mostly from the media, and from some funds, they based on this value strategy. And the strategy, when they talk about value strategy, it's basing on some value factor, like.
So is it like fake news? Is it like fake news, or are people trying to manipulate this there's an agenda to say that?
No, it's not fake news. Actually, if you base on those value factors, PE ratio, low PE ratio, or low price to book ratio, and high dividend yield ratio, the past 10 years actually you based on this strategy actually is way underperformed the growth stock. That is true. But as I said, value investing is not that. That may be part of it. That may be part of the value investing. In fact, in the past, even this value factor, like just based on price earning ratio or price to book ratio, they have been doing well. Okay, even over long term until now, they still outperform the growth stock. But the last 10 years, it did underperform. In fact, whether you grow value investing during different period, they perform differently, up and down. But basically, as I say, value investing is not just that. I will share with you what is value investing in my context, in my slides, right?
All right, awesome. Yeah, looking forward to that, definitely.
Yeah. So shall I share the screen now?
Sure, go ahead. Yeah. So for those who are just tuning in, so I'm Steve, the founder of MyPF, and Catherine, the host of PodCat, and here we are with KC Chong today, the author of Invest Like a Stock Market Guru, the complete value investing guide that works. All right, so feel free to ask any questions as well, and we'll try to answer some of these questions with KC by the end of the session today.
Okay, I start sharing my slides here. Can you see?
Yep, see, nice and clear, and your handsome picture there.
That's me. I've gone through that. Now this is my book, Value Investing Guide that work. Now this is a very comprehensive book. It covers almost everything about fundamental investing. Fundamental investing, I'm talking about when you invest based on you are treating investing in a stock as akin to investing in the business. That's fundamental investing. So this book is very comprehensive. It covers almost everything about fundamental investing. It even covers, like Steve mentioned, even covers some personal finance. I started with advice to a 25-year-old, a 24-year-old man, what should they do? And then there's this. I have also discussed about different options of investing. I will talk about the history of the stock market in Malaysia. Talk about asset allocation, diversification, risk management, that kind of thing. Before I jump into the hard stuff, that is a financial statement, how to read annual report, how to read, analyze, and interpret financial statement, and how to do valuation. Even like valuation, I talk about so many kind of valuation, including discount cash flow analysis, this kind of thing. So a very, very comprehensive book. And this book, you can get it from MPH or Popular. I think it's still selling there. That is my publisher, Ace Premier. You can get it from there, acepremier.com. Or you prefer an autograph copy from me, you can get it from me to this CKC book order at gmail.com. And that is my Facebook page. KC Chong NZ, KC Chong NZ, my Facebook page. You are welcome to visit it because I do write regular articles to share in the page.
Sure. We'll be sharing the links as well, so don't worry if you miss it out. We'll be sharing it by the end of the session, so you can get access to all those links as well. KC has also graciously agreed for us to republish some of his articles, so look out. We'll get some of KC's articles to be on MyPF as well, so you all can go get your dose of KC from there. And just on that note as well, for those of you who didn't know, KC used to be an independent licensed financial planner as well, and I really liked, as KC mentioned, how he starts his book talking about the basics of personal finances first before you even start investing. All right, back to you, KC.
Yeah. Okay, before I talk about what is value investing, let's talk about what is not value investing. It's important to understand what is not value investing. Recent rumors, a lot of rumors in the stock market. Stock tips, a lot of stock tips, free stock tips.
Hot tips.
Hot tips. So you know why people give you hot tips? Why people want to make you rich? So of course hypes, hypes. People keep on promoting the share, how good it is every day. Write about it, encourage you to buy. You have to wonder, why people try to give you tips and rumors, that kind of thing. The other thing, what is not value investing is day trading. With this MCO, a lot of there are a lot of new investor in the market. They hope to make money. They have got a lot of time. They hope to make money in the stock market by doing day trading. That means they buy and sell the stock within the day. Actually, very easy money, isn't it? You buy in the morning, you make 1 cent, 2 cents, and you sell off. You make a few $100 or a few $1,000. Very good. Okay, very good. So a lot of people do that, and a lot of people make money, few $100, a few $1,000 every day. But the time will come when they buy the stock, and the stock didn't go up. And suddenly, there are also cases that the stock just suddenly limit down, and day trading become investing for long term. Many of them. Why do I say that? They are actually, if you look at statistics, all this listen to rumors, stock tips, all the retail investor, 90% of them lose money. Only 10% win in the stock market. That is a plural of dabbling in the stock market. All these are speculation.
That's so true as well. Retail participation is an all-time high during the MCO, CMCO period, and yeah, there's that false sense of confidence, right? You do a few and you make a little bit of money, and suddenly you think you're a genius at trading.
Yeah. I have a group. My former classmate, engineering classmate in MU. We have a group. A couple of months ago, there are a lot of talking about trading, how they make money. They buy this and then they make so much money. Now keep quiet already. That time they talk about glove. They make buy and then they make a few $1,000s a day. But you know that after that, glove actually went downtrend. A lot of them get caught. So few people make money. There are people who make money in day trading or any way of investing, but very few. You must understand that all these are speculation, and speculation is zero-sum game. There are winners and there are losers, and you must know, like what Warren Buffett said, you must know who the patsy is. You don't know, then you are the patsy, because in the stock market there are so many players. The big timers are the institutional investors, the fund manager, those rich investors who got a lot of money, who can manipulate the market. Want the share go up, it will go up. Want it go down, it will go down. So if you are against them, whom do you think will win, and who do you think you win? They'll lose. There's no prize for getting the right answer. So we must think of investing as not a zero-sum game, but everybody gain. So you must think of it, investing in a stock as investing in a business. The business grow, everybody make money. So investing in business. What is investing in business? Invest in the people, in the company, the plant machinery they have, the products and services they have, the customers they have, the supplies they have. That is investing in the business.
I totally agree with you, KC, because definitely a lot of times people forget when you're not investing just a piece of paper or just numbers on the screen. There is actually an underlying business that's behind it. So thank you so much for that reminder.
Yeah, exactly, Steve. You're right. Let's hear what the Grandmaster of Value Investing says. I hope you know who's the Grandmaster. That's Benjamin Graham. So Benjamin Graham said investing is most intelligent when it is most business-like. So you must treat investing as investing a business. You must know the business, how the business make money, right? Is it making good money? And lastly, but not the least, is it a fair price to buy? That is investing. That is value investing. So what is value investing? In my context, PE, low price to book, high dividend yield, they are also value investing because you buy cheap things, right? But that is only part of the story. In my context, value investing is to buy quality company at a good value. What do you consider a good quality company? A company has a high return of capital. It's either a high return of equity or high return of invested capital or high return of total capital, but high return of capital. It's logical.
Do you look at all three of those measurements, or does it depend on the type of company that you're looking at?
I look at all of them, three of them.
All of them.
Yeah. Of course, number one is return of capital. A company must earn high return of capital, at least higher than the cost of capital. Capital has a cost. So if your return is less than your cost, then it's a value destroyer. You lose money. Next thing is cash flow. Return actually is earnings, but very often earnings are not translated to cash. A lot of earnings, especially like those construction company, they have a lot of earnings. There could be a lot of earnings, but earning is what people owe you or what you think people owe you. But the client don't pay you in cash, you see. So cash flow is important. The earning must be translated in cash flow. Of course, the third one also very important is the growth. So three things: high return of capital, followed by cash flow, and the company growth potential. So you look at these three things. If you tie them together, I call them the three musketeers. You earn high return with money. You reinvest your capital because of high growth. It compound. It make a lot more return, more cash flow. Reinvest, earn more and more and more. So is the most important, the three things important in investing, right? So what are those characteristics of those high quality company? Fast moving product, well known brands. People keep on buying and consuming. Beer, Carlsberg. I am a golfer. I got this golfer group on Saturday when I was back in Malaysia. After the golf, we go to the terrace, drink. And after that, we go for dinner, drink. After that, they all go to the pub, they drink. So, and you go to coffee shop, you will see a lot of these tables, with full of these bottles, empty bottles, very fast moving products. Nestle, Maggi Me, Nescafe, everybody consume every day. So all these products, they have very high return of capital, very excellent cash flow. Then products.
So this qualitative characteristic you're talking about would be brands that you recognize or you use. Is that how you define that?
Yeah, it's part of it. Part of it. When you define quality company. Okay, we have other quality companies or products and services that always are purchased, like glove, in food handling, in healthcare, is always purchased. Drugs, medicine, Standard and Poor. This what do you call it? Bond rating company.
Rating agencies, yeah.
Rating agencies. You need to issue bond. Then you're going to go to rating agency to give you the rating. And the bond market is much bigger than equity market, in the world. Like this big four, if you have company, you need to submit your financial account. You need them. So these products are always purchased by people. Then next, qualitative characteristic, premium products. Those are like Longines, very high end. My Citizen watch is only a few $100. Longines might cost you tens of thousands. Tiffany, this jewelry, with a nice packaging, will cost you a few $1,000s more. Hermes, remember the Belkin, the bags. So these products are very high margin, high return of capital. And products of services, high scalability. Netflix, once they have developed the firms, so any new customer just add to the bottom line. I use Microsoft product every day, Word, spreadsheet, presentation, and same thing. Once the product has been established, just need to get customers. So every customer they get, the revenue goes to the bottom line. There is high scalability. Software developer, Tencent, which developed the games. Actually, I was very surprised. Those people. There are so many people, especially youngsters, in the world playing games. I don't play games, but I was so surprised. So many people play games. So same thing. They developed the game. So get a lot of new customers. All went to the bottom line. Of course, Tencent also got these other things like WeChat, that kind of things.
It appears most of the scalable companies are all more tech-related or in the technology sector.
Yeah, generally, yes. Because the marginal cost is very low. Additional customer doesn't cost them anything, right? For technology company. So the marginal profit equal to the marginal revenue, high scalability. Then network effect, more people use Google. The more people use, the more people will use. Facebook, I started to really use Facebook only a few months ago, and I use it. I do it every day now. So I get connected to so many people. So there's a network effect. More people use and more will use. Same thing, you sell things in Amazon because there are a lot of buyers. So you as a seller, you want to go to a place where there are sellers. So when you go sellers, more buyers will go. It's a network effect. Alibaba, B2B, B2C, C2C, more people use it. So the more people use, the more valuable. Then the other thing, characteristic of quality companies, low price with a name. I call it low price plus by name, like Walmart. They sell every city in US. They have Walmart, and they sell cheap thing. They have bargaining power because they are buying so many things. So very high return on capital. Home Depot, all this very high asset turnover. So very fast cash conversion cycle. So that will give them very high ROC. So these are all the.
You want to define the cash conversion cycle briefly for those who are new to the term?
Yeah, cash conversion cycle is when you produce something, you're gonna buy. Somebody orders something from you. You're gonna order the material. You make it, okay. Then after that, you sell it to your customers with credit. Then after that, your customer pay you, and then you also pay your debtors, the suppliers. So the time from the time you start ordering your materials to do the thing until you get the money, so that is a cash conversion cycle. How many days it take you from starting to buy the inventory to collect money from your customer? That is the cash conversion cycle in terms of days. All right. Okay, I just talked about the quality aspect of value investing. Is there any question before I talk about valuation? Because a company can be high quality company, but if they're selling very high price, you will still make money, but you won't make a lot of money. But if you're able to buy at a fair price, best still, if you can buy at a cheap price, then you will make a lot more money. That's why.
Is it like saying that the profits are in a way already made when you actually buy the company or buy the stock at a particular pricing?
No, there's no guarantee that you buy even you buy good companies. There's no guarantee you'll make money. You only make money only after you sell them, right? So what I'm trying to say is that when you buy the companies, you must be able to estimate what is the value. Then you know what price to pay. So eventually, because you pay a low price, when people realize the value of the stock and the share price go up, then you make money by selling. Okay. Did I answer your question?
Yep, definitely. Okay. Look excited to know more about how do you look at valuations? How do you analyze stocks, the fundamentals of companies, etc.
Okay, I'll just talk about the analyzing the quality aspects of the stocks. That is the first part. of the analysis. And now is the value part of it. How much should we pay for it? There are some simple valuations. Things like PE ratio. I think most people will know it. It's a very common valuation metric. That is PE ratio, share price divided by the earning per share. They give you a PE ratio. Some people say that if PE ratio is below 10, then it's a good buy. But PE ratio depend on industry, depend on the type of business. So, but generally, if PE ratio is 10, it's good. But for some high growth company, PE ratio 30 doesn't mean that it's expensive. Then next one.
That's, is there like a maximum ceiling that no matter what industry it is, say if the PE ratio is above, say 40 or 50, that's something you'll say, oh, I'll never touch that because that's way overvalued?
Whether a PE ratio is high or not, one of the very important things, it depends on the growth. What is the expected growth of the company? If the growth of the company, like things like you talk about years ago, Amazon is growing at maybe 80% a year, 100% a year. Even the PE ratio at 100 is still not expensive, is it? Because as a company grow, the revenue and earning grow. Definitely, I mean, obviously the share price will go, will grow. So not really a ceiling, but of course, if the PE ratio become a few hundred, no matter how high the growth, also it's difficult. PE ratio. Some people interpret PE ratio as the number of years to get back your investment. So if the PE ratio is 100, it means that you take 100 years to get back recoup your investment. But that is provided that the company doesn't grow. If the company also grow 100%, then very fast earning will overgrow the price. So not really a ceiling, but as I say, not too high. I mean, for like traditional business, okay, give you an example like bank business, where there's very limited growth. If the PE ratio is more than 20, I think it's very expensive already, right? Whereas for a company like Tencent, where although it's a big company now, it's still a potential, it's still growing at 30%, 40% a year. PE ratio of 30 is nothing. It's still very fair, very reasonable.
Yeah, definitely shouldn't be just looking PE ratio just in isolation, right? Yeah,
exactly.
Yeah. What other valuations then will we be looking at?
Yeah, the next one is price to book. It's also a common valuation metric. But I don't use it that often already because a lot of business, we actually look at the earnings. It's an earning potential which drive the share price rather than the book value. But I just mentioned about bank, except for banks and financial institutions, price to book is very important because banks, the asset and liabilities are marked to market. They have a market value. So the price to book is a very good valuation metric for bank. Other than that, there are a lot of like those tech companies, they are very light asset. So in fact, a lot of assets are not captured, like those tech company or light asset company, they have a lot of asset in terms of intangible assets, you see, like the people they have, the brand they have, the kind of things are not captured. So
does it make it even more challenging then for especially if you're investing in Malaysia, where there isn't any metric actually for all this intangible, at least overseas, you would get at least a valuation of, let's say, the brand value, etc., but you don't get that, say, in Bursa Malaysia, for example. Does it make it more challenging?
Yeah, you see, take example like the technology companies in Malaysia. I think many of them the PE ratio are quite high. They are like PE of 50, 60. But unlike the US companies where they still have a lot of growth potential, Malaysia is a small economy. The growth potential is not there. Then I would think it's quite high in terms of valuation, in terms of PE ratio of 60, 70 for those tech company. I think they are quite a lot of them quite high. But that is an in thing. A lot of people are chasing these technology companies. But I think it's quite a bit high for those Malaysian companies. Yeah.
Thanks for sharing your input on that.
Yeah. Next one, price to cash flow. Then the other one is dividend yield. Dividend yield used to be a very favorite investing strategy. They tend to buy high dividend yield company. One reason is that only company making profit can afford to pay dividend. You know? Some companies say they make a lot of profit, but they don't pay dividend. We don't really know whether they're actually making money. You know, the earning actually is real or not. You know? But if the company pay dividend, then we know that company actually making dividend. So dividend has been a good investing strategy, especially now at this low interest regime. When you put your money into bank, where you earn less than 2% interest, if you get a dividend stock like Maybank, you get 4.5% dividend yield. Maybe it's a good investment. So especially retirees, they want regular income, they will look for it. But bear in mind, when you go for dividend yield, high dividend yield, you must make sure that the dividend is sustainable. Okay?
That's true as well. On the risk-free rate, definitely above the rates as well. But how about for, there are some thoughts that, if you're investing, let's say overseas, for example, in the States, and, dividend is actually taxed when you get the dividends declared. Actually, there's a 30% dividend tax. So in that case, wouldn't it be better to invest in stocks that, especially overseas, so in the States, that don't actually declare dividends?
Yes, I fully agree with you, Steve. Yes. In US, when a company make money, it's taxed at a company level. When the company declare dividend, when you go to individual investor have to declare income tax again. So there's double tax. So it's not, in fact, high dividend yield is not very good for US companies because of this tax. A lot of tax. Rather than, you get the dividend, the company reinvest back the company into the company and make more profit. And then there's a capital appreciation of the share. That is better. Yeah, you are right, Steve. I fully agree with you.
On that tangent as well, how about for companies that are buying back their own shares? Would that be part of the valuation that you look at as well?
Buying back shares, if the company got a lot of excess cash, Apple recently they bought back a lot of shares because there are a lot of cash, buying back share is just like a dividend, it given back to shareholder, because once they buy back share, the less outstanding share in the market, the earning per share will be higher. So it's another way of giving back to shareholder. But some companies, they buy back share, just to support the share price. Even though the share price may not be cheap, that is not good. But if the company buy back share because the share price is very undervalued, that is good. That is good. So it all depends. I would leave it to the management, because I think I recently, like everybody know, Top Glove bought back a lot of shares.
A lot of buybacks, that's right.
Yeah, there are a lot of criticisms on that. For me, I very hard to say whether Top Glove at this price, in view of the vaccine thing, is it really still undervalued? But that's what management thinks. So I believe they know better than me. Hopefully. So I hope they actually know that the share is undervalued, and it is true. Then it will be good for shareholders. Right? Okay.
All right.
No, that just now the valuation metrics are those from the angle of equity shareholder, from common shareholder. Those are very easy to use. When you talk about let me go back. When you talk about P/E ratio, very easy. Price, in the market price. Earning is all in the income statement. A lot of websites provide you with earning. Price to book, the book value all provided for. Dividend yield, everybody knows. Very easy. These are very quick and dirty way of valuation from the angle of equity shareholders. There is also this valuation from the whole firm level, because some firm, they may have a lot of borrowings. So if you use PE ratio, sometimes you can distort the real picture because the firm may have a lot of borrowing, or some firms, they may have a lot of cash, the cash which are not actually needed for the operation. So I also use this valuation from the firm anchor point of view, using enterprise value. Is the whole enterprise rather than just from the equity point of view. I don't want to go in detail because I will take some time. So the multiple use for using enterprise value, you have enterprise value divided by the EBITDA, earning before interest, tax, and depreciation and amortization, or EBIT multiple, and enterprise divided by EBIT, not PAT is just EBIT after tax, or you use enterprise, how many times enterprise over the sales. So this is the valuation on the firm's level, the whole firm level, right? So, of course, the other thing is actually I talked about intrinsic value. Intrinsic value is what is a value? Is it all those I talked about before that are relative valuation method in compare with the market, compare with the peers. But actually, the share, as we mentioned before, the value of the share is depend on the discount cash flow of all the future cash flow. What is the value of that future cash flow? So that is using discount cash flow. I won't go into that. So you get from that you get the intrinsic value of the share. Generally, intrinsic value goes up, but is going up slowly. But the share price different. Share price fluctuates. You can fluctuate up and down, up and down, up and down. So if you know the intrinsic value of a stock, when the share price is below it, then you buy, isn't it? You buy a cheaper price than the value. That is value investing, right? But in value investing, we have something called margin of safety. We want to buy a certain amount below the intrinsic value, 20%, 30% below it. If it's below that, then we buy. So we buy it at a margin of safety. So even though we may be wrong in estimation of intrinsic value, yeah, you can always be wrong, because it's very subjective, intrinsic value. Because intrinsic value involves future cash flow, is a forecast. So often that you are wrong. So because of that, you want to have a margin of safety. You buy way below it. Of course, when the share price go up, the intrinsic value, then you sell. You get out and you make your profit, you sell. So that is intrinsic value of valuation.
Is discounted cash flow the best model in determining intrinsic value, in your opinion?
Actually, when you talk about determine intrinsic value of stock, that is the only way. That is the only way to determine the intrinsic value. What is the actual value? The other things, the other valuation, they are relative valuation. They are not basing on intrinsic value. They are just basing on relative values. What the market price them in relative to others. But intrinsic value, they are flaws. It's not I wouldn't say it's the best method of looking at price versus value, because a lot of people don't even use it because of the uncertainties in forecasting of the future cash flow. A lot of very, very good investors, super investors, some of them they say that this is actually nonsense, but I think it's useful. Although the value I get, it varies quite a wide margin, but at least I have an estimate value of it. Then only with the estimated value, then I can decide what price to buy, isn't it? Without a value, I don't really know what should I pay.
True, not perfect, but yeah, that definitely helps as well. Another point you raised as well, KC, was you mentioned selling as well. When the price goes up to a certain point, is there a rule of thumb that you use, or how do you go about that for disposing or exiting a position that you're holding?
If you read my book on when to sell, I have an article on that, when to sell. Generally, if the share price had gone up to intrinsic value, we sell, right? because it's already above the value we sell to get profit, right? But sometimes we we are just individual investor doing our own analysis. Even professional analysts, they can be wrong. When the share price keep on going up, you might wonder, is my intrinsic value estimation right or not? So sometimes if the share price gone up beyond my intrinsic value, I still hold it, unless it gone up to a certain amount. So for me, there's a margin of safety of selling also. If the share price gone up, say 20% above my intrinsic value, estimated intrinsic value, then I sell. But before that, I might just keep it, because I could be wrong in my estimation also. Why the share price keep on going up? There must be something I don't know, isn't it? Right?
Although if you say the investor was trying to play it safe and it's already gone up, say, at or above the intrinsic value, but instead of selling all, they dispose maybe just part of it, a third or 50%.
Good point. Excellent point, Steve. Excellent point. Maybe just slowly dispose part of it, get some off the tables. Good point.
All right, awesome. And next, you were wanting to share with us as well, right, about QUALITATIVE's yardstick of value investing.
Yeah. That is a question. Share with you my QUALITATIVE yardstick. I know QUALITATIVE quite well. As I said, we sometimes have lunch together. Long ago, QUALITATIVE, the yardstick, it's slightly different from now. Now I'm talking about QUALITATIVE yardstick now, not the previous one. He emphasizes growth a lot. He in fact said, no growth, no buy. Must be growth, which is logical. It's only you buy growth stock, then the share price will go up, then you make more money, isn't it? If no growth, it's just like putting your money in FD. You earn the same. But whereas it's a high growth, then you make a lot more money. When the revenue earning grow, the share price will go up. You make more
that's
money.
That's true. Definitely.
So for him, number one yardstick is growth, right? But bear in mind, growth is a future expectation. We don't make money from past growth. We are making money from the future growth, and future growth is full of uncertainties. You must be very good, very good in estimating future growth. The next important thing you talk about is return of equity. Previously, I talked about return of capital. Capital can be equity or invested capital, whatever. He emphasized on return of equity. For him, he wants simplicity, because return of equity is much easier to understand and to extract out. Return is net profit. It's the income statement there, isn't it? Every income statement got a net profit, net income or net profit. Equity, equity, you look at the balance sheet. You have the equity attributed to common shareholder. It's all there, So you just take this number, the earning number divided by equity number, you get return of equity. Of course, you want to have a high return of equity. Sure, if you have so much equity in your company, if you earn 2%, what for? Might as well liquidate it and then give me back the equity so that I can invest in other things. I earn 10%, 15%. So you must have high return of equity, higher than what the required return from the equity shareholder. If you invest in this company with an aim of getting 12%, the return of equity must be higher than that. Otherwise, I will take the money and I will get the management, liquidate the company, give me the money, and then I invest in other things, isn't it? So that is important. Then he talked about cash flow. These three are what I call quality metrics to gauge the quality of the company. So as I mentioned before, return is accounting number. It must be translated to actual cash. Does a company actually get the cash from their earning rather than just accounting earning? So these are the three things. But he didn't mention about how much. But for me, like cash flow from operations, the important cash flow segment I look at is cash flow from operating activities. It must be at least equal to your net earning or more. because cash flow, you have depreciation, which is add back to the cash flow statement.
That's right.
So it should be more than earning. But of course, a growing company will need a lot of cash also. A growing company need a lot of cash for working capital, increase in working capital, in capex. So sometimes a growing company may not have good. I'm talking a different cash flow on operation. It must be good, but there is this thing called free cash flow. That is, free cash flow is cash flow from operation. Then after you spend money for capital expenses, after that you get free cash flow. This free cash flow is where the company can use it to distribute part as dividend, share buyback, or reduce the debt, or go and do other investment. So that is free cash flow. A growing company, for ordinary company, I would like to have good cash flow from operation, which is equal or more than net profit. Right? But I also want to have free cash flow for ordinary company, so that that you can give me some dividend, or you can invest in other things to make more money for me. But for growing company, because the need for additional working capital, and especially for additional capital expenses, you may have negative free cash flow. That is all right. That is all right for high growth company. But for high growth company, very important, you must have high return of capital. Otherwise you will be that kind of growth will be value destroying. I hope you understand what I'm saying about. Okay, so these three things, quality metrics for KOI, important for him. Then valuation, he look at PE. PE ratio must be less than 10 or whatever. Also, PE ratio, as I mentioned before, very easy. The price, you can look from the your price. What is the price? Everyday price. Earning per share. Very easy. Either from from financial statement. You look at the trailing 12 months. What is the earning per share? Then you get a price. Very easy.
Very easily available information.
Yeah, very easily available. Then the other thing, dividend yield. You talk about dividend yield. As I mentioned before, a company if they only make money, then they can give dividends. So that is assurance to shareholder that they have something back. And this dividend yield, they can compare with alternative investment, like putting bank deposit. If I get dividend yield of 5% from a company, very, very good. It's more than twice I can get from fixed deposit. So these are the 5 things about KOI 5 yardstick. This is a quality metric for the first 3, and value metric on the first 3. These are very good because it's simple to use. It's simple to use, and it covers everything. Why it cover everything? Must have high return of equity. You growth, no point. You must high return of equity. Must have cash flow. You say you make a lot of money, very high return of capital. Where is your money? Where is your cash? You show in the cash flow. It's a cover. It cover everything.
Definitely, also, pretty comprehensive.
Yeah.
Just 5 simple.
You also cover valuation. Although it's simple, but it cover everything. Quality as well as value. Yeah, that is KOI 5 yardsticks. Yeah, I'll finish my sharing.
Very interesting sharing. Yeah, it is true that it's very interesting to learn about all these fundamentals. Without this, then it would be speculating, right? And it's true that it's all very logical, right? Okay, so now, what is your next book or projects that you are currently working on? Or maybe there's something that you are secretly working on that...
Catherine, as I said before, I'm not a kind of material to write book.
Just being humble.
Yeah, when I wrote my first book, there are so many mistakes. But I was actually encouraged. I was actually motivated after the publication of my first book, because as I told you before, I didn't expect it to sell. I expect to subsidize my publication. But actually, I myself, I sold about 1,008 on myself.
Wow.
Just from me, myself. And then, of course, in MPH and Popular, I think total, I don't know, this John Lim never update me. I think probably about 5,000 books. It's not much. but for me, it's a very motivating, very encouraging. I don't have to subsidize the book. I can actually make some money. I can make some money from the book. Not much, but I make some money. It's not like Ko-ai. Ko-ai got 3 or 4 books. He told me each book once published, you sell thousands. So for the 3 or 4 books he published, I think he told me his publisher make millions of. And his loyalty also got maybe a few million, but to him a few million is nothing lah. He rather, if really talk about money, he rather focus on investing. He make a lot more, but it's the motivation. So after I published my book, actually surprisingly they are quite good feedback from my readers. The feedback and those people who bought the book from me, I promise to answer any question they have so I answer the questions. So from the question they ask me, I find that maybe I can write a lot of things. So now I have this book called Lessons Learned from Investing.
Lessons learned from investing.
Yeah.
Wow.
Yeah, because
is that already published and available?
No, not yet. It's
okay.
Coming soon. Yeah, coming soon. So in that lesson learned, because they were based on all the questions the readers asked me they asked me things like whether this stock can buy or not, whether I now the market is so hot, whether I should do trading or not. So I show them the lesson I have learned through the years. I think I quite good, some good lessons maybe next time you should buy my book, Lesson Learned to Investing.
Definitely keep us posted on it. We'll be happy to review and share on the book as well.
Yeah, but as I say, it's not so much of because I can make money. No, it's more for sharing. The other thing also, John Lim also encouraged me to write more, because he said my first book very heavy. I think you agree with me that my book is heavy, right?
That's why in the very beginning I was like, from my understanding, I think the toughest thing for you to do is actually to consider what to actually put in a book and what to remove it, because there's so many like useful information in it, and then I think picking and choosing is and like reorganizing is the toughest part.
Yeah, but take my words, if you read the book, implement it, do it, act on it, and if you are young, start young investing, I'm sure you'll do well. I only regret when I was young, I was never given this opportunity. I am too late because all these things need time. You need time arbitrage. Investing, you need time. Not you heard a lot of people I make so much money. Those very few of them in the short term. So my next book, Lesson Learned, as I say, a lot of work, a lot of correction. My publisher come back with me, so many grammar mistake, so many. So it will maybe take some time. So those are the challenges. But
we'll all be waiting for the new book.
Yeah, content-wise, I think there are quite a lot of contents because it's my nature now. I've been writing a lot of articles and sharing a lot of investing. Yeah.
And now that you've gone through the process, and then definitely you call it a success for the book that you have written, and then now working on a second book. So what would you be your advice for any aspiring authors?
Oh, as I say, I'm not the kind of material to write books, so my advice may not be. I don't know whether I can advise or not.
I'm sure there are others, similar situations like you. There's some motivation.
Yeah, my advice, I think you follow your passion. Like me, I had a passion for investing, finance investing. So for me, it's a passion to write the book. So you follow passion. If you like something, you are good in something, follow a passion, write it, just do it, just act on it. Don't procrastinate. Don't be perfection. Don't think, no good. Don't worry about it. Just do it. But don't expect good reward from writing book. but do some publicity. I noticed that the publicity from the Age magazine, who interviewed me a couple of times, it helps a lot. And then there are some bloggers through this introduction by John Lim. Some bloggers asked me for webinar, for publicity. Then more people know about you. Then the more people to buy your book, then more people know about your philosophy. Right?
Yeah, that's true as well. Yeah, and that's also part of the reason why we're here having this chat today as well. And we look forward to also putting up a published review on the book after this as well.
Yeah.
All right. So KC, thanks for all the sharing. Yep. So what is the one big audacious goal or habit that you want our audience to take action now? If there is just one thing that you want audience to, like stop everything and just go do it right now.
You see, this financial education is very lacking. Investment knowledge also very lacking. One thing for young people, you must have this mindset that, okay, my career is important. That's where I put food on the table. But don't neglect your personal finance, right? If you want to get rich, you have to do it. You have to acquire the investment knowledge. Then you have to improve yourself, reading book, attending investment course, and then most of all, you must do it. Start investing. So you must acquire the knowledge, investing. Do it now. Do it now. Then I am very sure you follow all this, you will be rich one day. Right.
Good advice.
Yeah.
So we have a question from Daniel. So how did you grow your skill or knowledge in value investing? Was it by researching for your book or by practicing what you wrote?
Yeah, reading. Okay, reading from those good investor. Actually, there are a lot of resources in the internet. You do reading. Of course, you must do it, practice it, and use it, and improve yourself. Right? You will make mistake along the way. So reading, doing it, improving it. Also, I find that my writing also improve my knowledge. When you write in the public forum, you share knowledge, people bamboo you, then you learn. Actually, you learn through the process. When I start writing articles in i3, when I start investing last time, I'm very quantitative based. I based on quantitative metrics. Slowly, I go more towards qualitative, and I find it's improved a lot. So read, practice, write, very important also, and then learn.
Definitely, as you share, that's one of the best ways to learn as well.
Yeah.
Mm-hmm. Do we have any more questions, Steve?
Nope. This is actually one of our longest sessions, actually. So you can see I already had a very lot to share. We're a little bit close to the 75-minute mark, actually.
Mm-hmm. Too long, Too long.
No, it's good.
It's very, very good information.
So thank you for having me here.
Thank you, KC.
I'm glad to know you guys also through your website. You are doing great job. A lot of activities, a lot of good things, your personal finance and the kind of things. Very good.
Thanks, KC. Thank you once again so much for being here with us. We'll also be releasing after this shortened edited version, which will be on our YouTube as well as on our website.
Right. Thank you.
Yeah. Thank you. Bye.
Bye.
Bye, KC.
Hi everyone. I hope you really enjoy like the session that we had with KC. I learned a lot of things from him. It makes me feel like I go through another accounting and financial planning class. So, but those were really useful information if you actually learn the techniques and then apply them and then really do a study thoroughly. And yep. And also he mentioned like it's best to start early. So thank you all for listening again. And you can find the show notes and link on our website, mypf.my/podcat. Don't forget to subscribe, and I'll see you next week. Hasta pronto.